Hello YouTubers, and welcome back to the Independent Investor. Today is going to be a little bit of a contrarian view that is somewhat opposite to the what's happening in the markets. We continue to see the technology stocks, especially the FANGs, which stands for Facebook, Amazon, Netflix, Google, continue to draw more money in and reach ever higher valuations. I've said a few times, I feel at this point the market is coming towards the end of a long bull market run, and not always a contrarian. You can make quite a bit of money running with the crowd, but sometimes the hard part is knowing when to kind of veer off and protect your gains. So it's kind of what I've done, maybe a bit too early. I started down this road probably about 2 years ago, moving my money to more conservative type investments, especially higher dividend playing. So today, these are a few of my top ones I've had for some for quite a few years now, and I call them quite low maintenance. I kind of call them my 5-minute portfolio because I don't do a lot of in-depth analysis on them. They've performed well over many years. It's a conservative industry. They're all utility stocks. Their dividends increase from year to year, and their share prices also slowly increase over time. One other feature I like right now too, that these have a low beta by quite a wide margin compared to the market. So if you take the overall market, the beta would be 1, and if you take, say, a utility company and it has a beta of, say, 0.6, that means the stock is 40% less volatile than the overall market. And that means in an up market, the share price is not going to rise as quickly, but in a down market, it gives you a little bit more protection, as it will fall 40% less than the market overall. So all these companies I have today have relatively low beta. I'll mention the beta on each one. And again, that just gives you a little bit, because I'm kind of staying in the market because the technicals are still kind of strong and the market could drift higher. I mean, there's people that got scared out of this market 2 years ago and given up lots of gains. So what I prefer to do is kind of stay in the market, but just adjust as I go along, introduce maybe some short positions, move over to more secure, less risky investments like these ones I'll be showing today. One of my favorites, which I've had for quite a long time, is, which is up on the screen right now, is Brookfield Renewable Partners, and its symbol is BEP.UN, and it trades on the Toronto. Like I say, I've had this one for quite a long time, and it's actually probably outperformed a lot of popular technology companies. So you can see here, this is a weekly chart going back to 2010, and you can see it's just a nice channel. It slowly drifts up. And from this, I'll give a little bit of an explanation of what the total return is. So in this case here, you can see in 2012, back in here, the stock was trading about $45. 2017, currently around $42. So if we remember back to high school and slope being rise over run, we can do something similar here. So if you take the rise the stock went up divided by the number of years, you end up with about, using the medium line here through this pitchfork, which is kind of the average price, and you get roughly an increase of about $3.4 per year. So that's your capital gain, which you can see it has been, with some volatility in there, has been quite steady. So we've got 4 in capital gain. If you divide that by the share price, that gives you about a 7.9% a year capital gain. And then if you add the current dividend or dividend yield, you end up with about, because the dividend yield right now is about 5.6. So if you add those two together, you end up with about a 13% return per year over a relatively long period of time. Now all the companies I'm going to mention today kind of have this split between income and capital gains, more towards the capital, the dividend side. Brookfield is quite unusual in that it has performed so well, and its business is kind of almost bulletproof. It's an electricity producer, and predominantly in the hydraulic or water power generation like Niagara Falls, and they've slowly expanded this from Canada into the United States and now into Mexico. So these are very reliable. Hydraulic plants is one of the most reliable ways to, and green way to produce electricity. A lot of these plants just can run away for 20, 30 years and then have an overhaul and put back into service. So they just continue to produce good, steady cash flow. They have expanded out now into, it's totally green energy. I think they have some wind generation. I'm not too sure if they have any solar, but it's just pretty rock solid. And getting back to the beta actually on this is negative. So that means if the market was to drop, the share price here would actually go up, which is kind of rare. Usually your beta is positive, but in these cases lower or less than 1. And I kind of see that happening if we have a market correction. Not all money can leave the market, of course. You've got pension funds, you've got even people's 401ks and things like that, and they're going to shift towards a safer investment, especially with something with income. In my case, I typically just add to these positions when they kind of come down here on the lower side of the pitchfork. I wait for a bounce up. I never buy while it's going down, and then I just slowly keep adding my position, which I've been doing for quite some time. So my average price is quite low on this. If we did have a market correction, there's two schools of thought on that. It's most likely going to come back, like even it did in 2009. But if it started to really look like it's going to drop out of this trend, I would probably sell at least maybe 3/4, sit on the sidelines for a while, and then re-enter. By doing that, you're going to re-enter at quite a bit lower price, and that's going to bring your dividend yield back up. So I mean, if the price drops 30%, they keep their dividends the same, which is most likely because it's very stable income, then you can kind of bring your dividend yields back up again, which is a nice thing about a correction. If you kind of do get out, I did that in 2009, and I was fortunate to get a lot of REITs paying dividends of over 10%, which were pretty safe. They were safe because the share price came down so much, and the REITs, the incomes, didn't drop by the same amount. So that's one way of playing it. Again, I'm very conservative on these. I mean, I'm not really trading. I probably haven't done a sell on here in a couple of years, so it's pretty coarse that way. So that's one I really like. Another one is Enbridge. Again, we'll see the same thing. Enbridge has been not the last few years, but again, over the very long-term period, it's drifting up. I'm not sure what's happening right now. It has dropped down a little bit, and I haven't really seen any news for that. It's in the energy field, transportation, storage of liquid and petroleum, like gas and oil. Pays out a high dividend. It's right now 6.78, which is quite stellar in the market we're in. And another really nice feature is it pays out its dividend monthly. So if we did have a market correction, you wanted to get out, it's not like you're giving up that quarterly dividend. The most you're going to give up is 1 month. So that is a nice feature. The dividend payout ratio is important on these, and sometimes I'll go to the cash flow statement, look at the cash flow from operations, how much money they generate from cash flow, and look at the dividends. And most of these, the cash flow from operations is quite a bit higher than dividends. Although the dividend payout ratios are quite high on most of these, because that's really their focus. Occasionally I will let the dividend pay ratio go over 100, means that they can't really support their dividend. If I know it's for a particular reason, like they've got major capital projects, these are capital intensive, and then once those projects are finished, the capital costs come down, and then the dividend payout ratio will drop probably back to where it was historically. So you have to assess that kind of one by one. So that's Enbridge Income Fund, and that's ENF on the Toronto. One I've also had for quite a long time is TransCanada Pipeline. It had quite a sell-off here back in July 2014, and this was a company actually I'd watched for years and years and never had the opportunity to buy because I always thought it was a bit too expensive. So I kind of jumped down in here, tried to figure out what was really going on. Didn't seem like it was going to be any long-term problems with that, so I bought in quite aggressively, and I haven't really been buying too much recently. Again, we've got that kind of long-term trend up, so you're going to get your dividend and your capital gain. Its dividend's a little bit lower, it's about 4.1, but if you get a 2 or 3%